All right. Is this on? Everybody good? All right, everybody? We do now. All right, we're going to start. You'll notice I repositioned where I am up here. It's a little easier to see everybody from here, so I thought I'd take the liberty to do that. So here's the game plan. We had a number of folks in the queue already, with a few of the panelists who asked to get in the queue. So we're going to work through the queue. Once again, I'm going to ask folks to try to keep their remarks on the briefer side, but I think still the precision and the like continues to be key as points and perspectives, commonalities, differences emerge. We'll go through the list. We've got a ton of great questions from the audience. Given the limitations of time, we won't be able to get through every single question, so I apologize in advance for that. But I'll do my best to get through as much as I can and to try to probably consolidate some that are more thematically aligned, so we can try to at least hit the topics, if not get to a specific question and intersperse with some thoughts. And again, encourage the panelists to raise questions of each other as they think appropriate to motivate the conversation. So with that, and come back to the list, I probably don't have the exact right ordering, but I think this will do. Louis.
Thank you, Troy. Well, I think the break gave us a chance to all kind of reflect upon, I thought, an amazing and very, very constructive dialogue. And I think we heard many points of overlap and obviously some points of disagreement. I think that's fantastic. Really the point, Troy, that I was going to make just before the break primarily was the one that I said to Collins. You're still there. Oh, yeah. I'm looking in the right direction, which is that the idea of common enterprise, which is a key element of the Howey test, has been sort of left out of the discussion. And I think it is an important concept. Collins, you already touched on it, and I think as many of the folks here know, it is probably the most complex and painful piece of the jurisprudence on Howey. But I think the one point, Troy, that I would make very, very briefly here is that the one thing a common enterprise is a common interest. The fact that in and of itself, somebody has a lot of one asset and somebody else has a lot of the same asset does not make them in a common enterprise. They maybe have a common interest in the price of that asset, but it's not a common enterprise.
What if one of them's the issuer, though, Louis?
I don't know that word. No, because seriously, because the problem that we have is issuer is someone who has an inherent relationship. Yes, there's a creator. So as I pointed out in my submission from yesterday, De Beers is the creator or at least distributor of diamonds. They have a huge interest in the price of diamonds, and they have a lot of control over that market. But you can enter into a investment contract with De Beers. Hey guys, you're a little short on money. I'm going to give you $100 million, and you promise to cut the supply for the next 3 months while I'm liquidating. You totally have an investment contract, an investment scheme going on. You have a pooling of an investment of money, a common enterprise, a reasonable expectation of profits, primarily on De Beers' efforts, totally down the middle. But if you buy some diamonds with an expectation that De Beers is going to cut supply because you read something, that doesn't put you in a common enterprise with them. Does not make diamonds a security by itself. That's all. Anyway, thank you, Troy.
Yeah, great. I'm going to go to Ben next, but just one quick thought on that to go back to Howey for a minute, realizing that there's more to it than Howey, to be sure. But if one steps back even half a step from the 4 prongs of Howey and asks the question, what was really going on in this case? At least as the facts laid out in the Supreme Court opinion indicate, what was really going on is some folks were putting money into an orange enterprise. And I think that sometimes take a step back or 2 steps back can just be a useful way to think about, all right, on some of those close calls, this factor, that prong, the other factor, how do you actually apply them in some of those areas where it's not so clear cut? It wasn't I'm gonna get access to orange groves, I've given you a bunch of money again so I can eat oranges, or I can do this, or I can do that. It was essentially to invest in an orange company enterprise, which I think, Louis, goes along the lines of the point that you were making in terms of a common enterprise, whether that is synonymous with commonality, maybe that's a separate point because of vertical and horizontal and what have you, but just in terms of what is this thing that one's talking about really all about. Ben.
Thanks very much. I it was just something that Coy said that I thought was interesting. He was talking about how obviously it's not just the SEC that's interested in this question, that's going to, have a say in this question. It's also Congress, and then Teresa was talking about how it's not just the investment contract in the definition of a security. There's a whole bunch of terms in the definition of a security in the federal securities laws, and it got me to thinking, well, if we're just talking about how should crypto assets be regulated, what should Congress do? Is it really the right thing to say that the CFTC, for example, should be the regulator of crypto? My concern there is the CFTC doesn't have an investor protection mission. It's not used to protecting retail investors, which would be fine if crypto wasn't being marketed to retail investors, but I think it is, which is why I think it, in lots of respects fits within the definition of a security. But then, we were talking about the Howey test and all of these things. It got me thinking, there's another possibility if, it would make sense for the SEC to regulate crypto assets, which is that Congress could just amend the securities laws to have crypto assets be part of the definition of a security. Do I think this Congress is going to do that? I do not. But I think it is, something that, should be considered when you're starting from this kind of like clean slate, when you're just asking this question, what is a security? What, also as Teresa said, what's the sine qua non of a security? To me, if you have something where people are it's marketed to people as an investment, it trades on exchanges, the value depends on what other people are willing to buy and sell it at, starts to look like a security, you can kind of then just ask yourself, well, should it be considered a security, putting aside Howey and investment contract and everything like that? And I just think it's a worthwhile perspective to consider. And I know that this is a question for Congress, but my guess is the SEC, its views would be influential in this respect. And then, again, talking about writing on a blank slate, the SEC could regulate it however it wants, right? I know there's a lot of questions about, well, does the existing disclosure regime, fit? Who's going to be making those disclosures? Things like that. I mean, the SEC can write a whole bunch of rules to come up with whatever disclosure regime it wants, both so investors can be protected and so capital formation can be formed. I just think that if you're really talking about this fundamental question, what makes up a security and how should we regulate crypto assets, who is the best regulator should really be taken into consideration.
Chris, I know you had a...
Yeah, this is like a 30-second. I really respect and really like the question of just sort of asking, well, who should be regulating what? I would say that even when it comes to this question of disclosure, I personally went to the agency many times to say, hey, why are we not updating, why is CorpFin not updating some disclosure rules? And I think that for those of you who are familiar with the concept of tech debt, that kind of builds up, there's regulatory debt that's built up. And this entire process is sort of initiating the cleanup of all this regulatory debt. And assuming, and I think that, sure, I mean, the SEC has lots of smart people, they can address issues of crypto assets. The CFTC has lots of smart people who can tackle the issue. It'll ultimately be something that's happened in market infrastructure, but at the end of the day, we shouldn't just assume or minimize what that regulatory debt means in terms of any agency's regulatory competence. Thanks.
Yeah, I think, Chris, it's a really interesting point and a really interesting framing on an interesting point, and I think underscores all that is ahead of the commission, and I think underscores the value of your all having the chance to contribute to the discussion that we're having today. Sarah.
So, I mean, I agree on a lot of the discussion around we can't just rely on the Howey test, and that's just a function of there being regulatory debt, and that's why we want to do rulemaking. But in the interim, a number of lawyers and other advocates in the space put together an interim framework. I think the market would really be in a better place if we could start shuffling people towards better disclosure. and better practices and have a target to hit. People that want to signal compliance still are not able to do so, that are already in the market. And so I think that there's things that we could do with, like, knowing that we're not going to get it right with an interim framework with a sunset that looks sort of like another iteration of Safe Harbor 2.0, just to get some more herding of people in the market towards better practices. Because I think on the last administration, someone used to say a lot, an industry outside the regulatory perimeter won't long survive, and that was done on purpose. And so I think you could do really easily an initial sort of this market with a voluntary opt-in, and that's a self-sorting exercise right there, because if you want to continue to be a bad actor, you can vote with your feet either way. So there's that. And then secondly, I'm taking issue with, these analogies that the tokens are commodity-like, because tokens can be whatever the issuer wants them to be. I think you have to look outside that to the model. There are models where tokens are the only value accrual in a public permissionless network with open source software. Economically, those models will not work without the tokens as a value center. There's tokens plus equity, right? Those dual models. And if you raise money in the equity, as you raise money in the equity, your equity holders have more protections under law than token holders have. And so then you need to start being more careful of conflicts. And then we have like a public company potentially issuing a token as just like fundraising as a sweetener. And I think that in the context of the SEC's mandate, that we have to be very careful with investors, because tokens are in that stack, equity, debt holders, the least protected. And so the more conflicts your model creates, the more fraught it is.
Can I ask you just a quick follow-up, Sarah, just on that last, maybe second to last point on the stack in terms of traditional equity and then debt, and a company's capital structure can be quite complicated with lots of different kinds of securities or non-securities financing sitting within that overall capital structure. From your perspective, is it important, if one is going to consider a token to be a security, that one can situate it comfortably within a capital structure, or is that not so important, or is the view that if it is a security, if you kind of work backwards, then by definition it's going to sit somewhere because it's going to have some claim on the enterprise, and that then is going to be situated somewhere in terms of the seniority within the cap structure?
It sounds like we're back at what's a security. I just think that when I sort the market, there's securities on a blockchain, right? You slapped a blockchain on it, it's security. There's crypto-native assets that have functions that I'd like to see us optimize more for use than just trading. And then there's kind of digital pet rocks. And I think to collectibles, in-game assets, and I think like just that sort of initial broad sort, like I'd just like to focus on the tokens with use cases and how we kind of are letting, while protecting people, letting them actually be used and get into the hands of users and get network effects. That's sort of how I think about sorting the market, not, how does this asset trade or stack up, because that's like the financialization only of that asset in kind of a more fraught context. And I'd like to see the more pure models actually be able to proliferate and function, because there is no other value accrual center for them. They simply cannot function the way they were intended. They're being blocked by securities laws.
Got it. Lee, I think you were. I just have a cue that may not be in particular order, but I'm happy to go with John first.
Let me just go back to, I do have a point, but it's probably not related to Sarah's. To Collins' point before the break about vertical commonality, and obviously I recognize that is not in every circuit court a recognized form of common enterprise. Well, look, I am more than happy to concede if a protocol developer or issuer does not retain any tokens, then there is no vertical commonality. But I think we all know that is absolutely not what is happening when you look at these crypto protocols. I mean, look, if you truly cared about sort of decentralization and kind of restoring sort of power to users of a system, there's a 100-year-old model out there that exists called co-ops, right? Cooperatives. But the problem with cooperatives from the crypto industry's standpoint is that your membership share is not freely tradable, right? So the whole business model of create token, pump token, sell the tokens we have doesn't work within the co-op structure. Another point I want to make goes back to Miles's point about the Commission's approach to crypto over the last 4 years was not conducive to the mission of capital formation, investor protection, and market efficiency. I mean, I would say it's not because of the Commission, it's because of the industry. Never before in the history of the United States have we had an entire industry, when told what the law is, say, no, we are not going to follow it. Now, I know there are people in this room who have genuine disagreements over how the Commission interpreted the law, but I think the reality is that the industry chose not to because it was not in their financial interest to do so. So let's just put things in perspective here. And my final point is, as much as I appreciate all this work, the Commission has already taken significant steps in regards to essentially every outstanding enforcement action in the crypto context. So, and when you look at the filings in court to dismiss or pause these cases, it's predicated on the eventual outcome or the work of the crypto task force. So, it does feel a bit as though this work has been front run, and this has real implications for the market. I mean, the day after one case was dropped involving a platform, we had CME decide that they were going to list Solana futures contracts, right? And Solana had been a named security in this case, and so there's already setting in place a form of what I say policy lock-in. It's going to be very hard to undo if the task force does come to some type of determinative conclusions here. But markets have already sort of reacted based upon the initial dismissals. So I think that's another thing to keep in mind as this work progresses, because the market is already responding to the Commission's actions. They're not waiting for what this task force comes up with.
All right, so here's what we're gonna do. I'm gonna go through 3 or 4 folks. Let me get some questions, and I'm sure there'll be occasion to come back to a few folks. I know that Sarah had a quick response to what Lee was saying, then I'm gonna go to Miles and a couple of others, and then we'll get to some of the questions from the audience. So Sarah.
Yeah, I'd say that, suggesting that all of those regulatory actions were good faith is a little beyond, credulity. When being asked to register as an asset that got infected by an investment contract, there is a meme that went around, register as what? Register as what? I mean, the policy was constructed to keep people from a path forward. I know people that spent 4 years trying to find a path, negotiating all the way up to S1s, and they were blocked by it. And then, the other example that I'll give was when being asked to register your staking business, and you kind of sort of looked at what securities laws disclosures, were those in the better public interest than just terms of service? They really weren't. And so those are just 2 examples I would give of just, we have been trying for years to find a path for compliance.
Miles.
Yeah, I think to echo Sarah's point, I think that it's not really fair to say that the industry has just decided not to comply. I think that if you look at those that sought to come in and register, right, all of them went bankrupt. The SEC hadn't provided any guidance to the industry since 2019, even though the technology and the approach that people were taking had substantially changed, every year, let alone over the course of 4 years. The process was not constructive at all, and what that really meant, right, is rather than the SEC actually accomplishing anything in terms of investor protection, capital formation, or efficient markets, is what you ultimately did is you left lawyers like myself, Rodrigo, Sarah, Collins, right, to advise portfolio companies and clients, right, just based on 2019 guidance that really longer fit the industry. And when you're trying to advise startups, you only get to say no so many times, right? And when they, again, look across the street and say, hey, well, why is this person doing this? And you say, well, based on, 30 different factors that the SEC put out 5 years ago, it's a little bit difficult to get buy-in from entrepreneurs. So, I would say that it was not that the industry decided not to say that they wanted to comply. It was that there really was no way to comply, and guidance was not forthcoming. Now, going back to Sarah's point, though, about she is right, that the digital assets are not monolithic, right? And what you're hearing up here on this stage is there's two extreme approaches. One, let's treat these all like securities. And the other one is let's not treat any of these things like securities. Neither of those are viable frameworks. They fail to contemplate or even look at what the risk profile of these assets are. They're simple. They're very simple. And as a result of that, they're attractive. I understand that complexity sucks. But at the end of the day, right, if we're not going to actually grasp what are the things that de-risk these assets, make them look less like securities, reduce trust dependencies, right, which helps investors, helps capital formation, helps efficient markets, right, then what is our actual goal and what are we trying to achieve? We need to align the incentives of entrepreneurs, right, with the incentives of our regulatory structure, which is to reduce information asymmetries, reduce trust dependencies, reduce risk, okay? We can do that by giving them guidance that defines what the characteristics are that reduce the risk of digital assets. Failing to do so is just anarcho-tyranny.
Rodrigo.
Tough act to follow, but maybe just I'll respond to Lee's point, and then I'll try to make a suggestion for a clarification that I think the SEC can make that's important. I really have a problem with this notion that the industry was like a scofflaw and willingly breaking the law. I think it it doesn't take into account the fact that, as I maybe with too much detail described earlier, the law actually was not clear, and there were differing opinions about how the law applied, and it doesn't take into account the fact that there was no real path forward, right? So it was basically like the agency pointing at the industry and saying, why aren't you walking through this wall? Like, we want you to walk through the wall, and we were like, we can't actually, right? So I don't think that's an accurate portrayal of the efforts that I think many of the outside counsel sitting at this table, people that were submitting rulemaking proposals, people that were trying to advise and engage with the industry and regulators were doing, right? Moving to something that I think where the SEC could provide more guidance and I think it would really benefit the market is really clarifying their stance on the third prong of Howey, or the profits from the efforts of others, right? As I mentioned earlier, I think it should be relatively uncontroversial that purchasing something with a profit motive in and of itself does not turn the whole transaction into a security. But turning into the kind of second sub-prong of that, right, like the efforts of others, I think the SEC back under Chairman Clayton really was on the right path here when in the statement when Gary met Howey, they described how Ethereum transactions on Ethereum were sufficiently decentralized to the point where those transactions were not securities transactions. And I think what that means to me is that at that point, the efforts of others, those others were dissipated to the point where there were no information asymmetries or the type of agency issues that I think securities laws are intended inherently to address, right? I think since that, the analysis has become muddled, and it has resulted both in worse practices in the industry and worse information. I think the focus on enforcement actions that target developers or protocols that show any sort of value accrual to the token has led people to provide worse information to the market. People are worried to describe how a protocol might accrue value to a token, and I think it's also part of what's led to the focus on meme coins, right? I think, frankly, by persecuting a lot of the actors that were trying to provide tokens that actually accrued value, the industry responded by saying, well, here's, fart coin or whatever, right? That clearly has no value. So I think and I'm not, I think this, reasonable minds can differ about this, but I think one key unlock would be to try to understand how protocols where, they're being sufficiently decentralized so they're not controlled by any centralized entity can provide those revenues to the token outside of the securities laws. I think that is one of the key issues that has been holding back the fee switch discussions around a lot of the key protocols in DeFi, and one where if the SEC staff were to give guidance and clarity on how they're viewing that now, could be really beneficial for the market.
Can I just have one quick follow-up for Rodrigo, and then John, I'll come over to you. Just the very quick follow-up. What about the measurement practicalities, right? So one of the things I think when the discussion, it is not unique to crypto assets or even Howie for that matter, is you have to go from concepts or principles, as we were talking about earlier, to actually figuring out, all right, well, how do you measure if in a particular context of an asset, particular context of a transaction, in particular context of a market participant, whether it's an issuer or what have you, whether or not that thing, whatever that standard or that principle is, has been met, right? So all concepts, all principles need to be applied, and with that application, there becomes what, just to my mind, to put it very simply, is a measurement, just question and then challenge. To put it a little differently, there's always well, how much is enough, or how much is too little, and by the way, how do we measure that? So on some of the things that you were mentioning that you think would be helpful, do you have a sense or suggestion for how some of these concepts could or would or should be measured in practice?
So, I mean, honestly, I don't think I have the answer to this. I approach this with a lot of humility and the understanding that it's going to take, groups like this to try to fine-tune the language, and then, that language to be tested over a bunch of cases and figure it out. But I think the principles should be relatively uncontroversial. It's just because you're buying something for profit, and if that profit is not being derived from a promoter that's sitting back there telling you they're going to do things, but rather from a distributed group of people or a distributed network, moreover, particularly one that's not controlled by anybody, I think that raises fundamentally different issues than the securities laws were intended to address, which are agency problems and information asymmetries.
Yeah, and humility is a is a good thing.
I think to the point that you were making though about the economic value that is accruing to the token, right? I think that a clear delineation, right, would be, is that value accruing based on the programmatic functioning of the network, right? Or is that value accruing to the token because a company's taking its profits and putting them back into the system by buying the token and burning it? Right, so there are pretty clear lines of delineation that you can make, right, around whether or not this stuff is happening programmatically or whether or not a human is kind of in the mix.
I think,
John, Collins, real quick, and then.
Yeah, I was just going to say, I think to maybe one concrete suggestion as well is, I think starting with maybe the framework that we've used for previous regulatory exemptions with a rebuttable presumption and establishing certain thresholds for that rebuttable presumption is probably a safer route than trying to come up with, let's say, thresholds that will make a definitive determination. But I think when we look at a rebuttable presumption, using one of the examples we were talking about before, I think, was it Lee, or I think it was Lee, talking about maybe what does it need to look like if a common enterprise is established. We might start with a rebuttable presumption of under 10% holder, maybe a rebuttable presumption that there's no common enterprise. It doesn't mean that the government can't then come in and say, hold on, we're looking at affiliate relationships, we're looking at something else, and in the aggregate, we actually think this doesn't apply. But I think starting, and I think I get the sense that everyone's worried about setting a threshold, and then later we find out it's too high, it's too low. But I think that the solution to that is setting it as a rebuttable presumption rather than a hard threshold is probably the initial place to start there.
Yeah, I want to come back to that after John. In that, one, I think it's a really important point, and number two, there's some questions that other folks have submitted from the audience that speak to that. So it's going to be a great segue to some of the questions that we've gotten. But John.
Thanks. This goes back to this notion that someone brought up about caveat emptor being a bad regulatory paradigm, and I agree with that. I can't remember which panelist said it, because there are two critical omissions that I think are very important for everyone to consider, and I really hope the Crypto Task Force will consider them. The first are the externalities associated with crypto. They cannot be denied, and they cannot be overstated. Drug dealing, human sex trafficking, child pornography, terrorism, ransomware attacks. I'm a ransomware expert.
but for Bitcoin, there would be no ransomware. Lee and I teach at Duke University in Durham, and Colonial Pipeline was hit with a ransomware attack. And at that point, there was no gas in Durham. You couldn't get home from the airport. I mean, it started to get kind of scary. I've met with the FBI on numerous occasions to find out if there are any way that people can get their ransomware payments back. I write extensively in my statement why crypto is not traceable. You might be able to find where it is, but you know how much ransomware payments were ever recovered? Pretty much none. Occasionally you get lucky, you find some, in a laptop, in a popcorn tin, under a blanket, in a bathroom like they did in New York. But again, I go over this extensively in my prepared statement. Just think about last week, $1.5 billion, the greatest financial heist in the history of the world. It was crypto taken by, it looks like, North Korea and used for their weapons program. Now, everything that I just listed, there's always people who say, that's just not true, John, and fiat is much worse. It's just not, those points are really false, because if you look at every government report on this idea of the crypto crime wave, and I just think that the crypto task force should consider that. And then there's never really been a check of systemic risk associated with crypto. When Voyager, Celsius, BlockFi, FTX, when that big crash happened, it didn't really impact anyone too much. There were safeguards in place because the FDIC, the OCC, the Fed had all pretty much said to any bank that does anything having to do with crypto, and this is what the industry has called the chokehold, said, you better prove that to us, and it's going to be an indicator, it's going to prompt an exam, it's going to prompt scrutiny. Now, all of those, from what I can read, I'm not a banking expert, all of those guardrails are now rapidly disappearing. So if you look at, I was here at the SEC during the subprime crisis, and you might say, well, subprime, what does that have to do with me? I'm not going to take one of these silly subprime loans. Well, it impacted everyone. Or Enron, WorldCom, HealthSouth, when all those crashes took place, I was here at the SEC. And again, you might think, well, what do I care? I don't invest in those things. But that impacts everyone. And you really, when you look at that systemic risk, a friend of ours, Hillary Allen at she at AU or AU wrote a book called Driverless Finance, and I would recommend that everyone read it. And another guy named Arthur Wilmarth wrote a similar article about the systemic risks involved. And I'm a big Wizards fan. For the last 12 or 15 years, had season tickets. And I was at the game the other day in the elevator, and I'm talking to two of the security guards who know me, and they're like, Mr. Stark, I saw you on 60 Minutes. And I said, oh, yeah, I was on. What'd you think? And they were like, I just saw the end. You said something about crypto. And I said, yeah, it's a really dangerous investment. And they're like, really? We both invest in it. And I said, okay, should we stop? And I said, I'm not telling you what to do or not to do, but what do you think you invested in? And they had no idea. No idea what they had, and they laughed about it. They're like, I have no idea, I just heard it's a great thing. The power of FOMO, the power to turn the victims into victimizers is very serious. And so, when this, if it does cause a systemic crash, it's, ask not for whom the bell tolls. It tolls for thee. We will all be impacted. So I think these are important considerations for the SEC, and I think the idea of caveat emptor sounds nice, and I'm a libertarian myself. I totally appreciate it. But if you read the Celsius pleadings, you can read all the victim statements, and I have. And it's heartbreaking. It reminds me of the 20 years I worked here. You can say these people, they took it on themselves. They took this risk themselves. They knew what they were getting into, and they didn't care, and that's on them. Well, everybody lets their guard down every once in a while, and that's just the wrong approach to take toward victims. We all get duped. You all let your guard down. So I hope the task force will consider those ideas when they're trying to figure out whether this should be part of the SEC's mission or not.
All right, well, I was going to pivot, but I'm not quite going to pivot because I got a lot of folks getting my attention. But I'm going to pivot in 5 minutes, so everybody's going to make this quick. So Sarah, and then Chris, and then Teresa, and then I'm going to pivot us a bit, and then I'm sure we'll come back to some of these themes.
So I would just quickly respond on the last point that those institutions that you named, I think that's a symptom of being forced outside the regulatory perimeter. And what you are naming are centralized intermediaries. And a lot of that fallout was from counterparty risk, which is a risk that is inherent in TradFi. And there's actually some studies that DeFi withstood contagion risk. It was one of our first studies that we saw that it actually can break contagion risk. So as a structural counterbalance to traditional systemic risk, that would be something to lean into. But given the size of the relative markets, it's a who's locked in here with who. TradFi is likely to be the risk source that creates contagion for a much smaller nascent market.
Chris.
So just to piggyback off of that one point, I was about to say systemic risk is definitely something that that regulators have to worry about. Certainly, I think banking regulators, to your point, John, will have to tackle in particular, but also to the point that the vectors for that systemic risk, if not, the TradFi will be just more the centralized players, and therefore you have to ask questions about interconnectivity. But I was only going to speak because of the caveat emptor point, which I brought up, so I said, okay, let me go. What we've ultimately had over the last several years is an idea of we're not going to regulate, and because if we do, it's somehow going to add some kind of legitimacy to the market. So we're going to sacrifice our little lambs here of investors who may get duped or something, but we're not going to lean in. And I don't think that that's a sound regulatory strategy. I do not believe that caveat emptor is a regulatory strategy. It does also, as the point I made earlier, it creates regulatory debt. It just creates a void, and it gets messier and messier and messier to clean up. And that's why we're here today, and that's just, from observing things from across the street.
I don't disagree, Chris, but I'll point out that caveat emptor was the logic behind the recent statement that meme coins are not securities.
There are several forms of regulatory guidance that I think are necessary. Admittedly, when you have the absence of defining where at the top of the funnel in general the regulatory approach is going to be, I think it does make it problematic and difficult. I have to admit, we've had a very wonderfully busy and active SEC, so I haven't read every single thing, particularly in the last week that's come out.
To quote Commissioner Peirce, don't go running to mama government if you lose a fortune on the Trump coin. So.
I wasn't going to get into meme coin and what's a definition, but again, it does. I have no idea what's particularly into the meme coin thing, but certainly, if the expectation of profits prong is a big question in terms of what's defining, and if you're really, really curious, what defines a security. If anything, I have said with people that you and I both talk to very frequently, that is a challenge for trying to classify a meme coin in and of itself, not tied to a larger transaction, but in and of itself. If there's no expectation of profit, it's kind of hard to pin Howey there. I do want to reiterate a point that Rodrigo made, which is incredibly important, which is just because you want to invest your money doesn't make it a security. And this goes back to, and I can't believe that what I said at the very beginning of this place is actually going to be important. I was just trying to buy my time. But when you think about why securities laws exist in the first place, it's not to say. Notice that there are 4 prongs. There's not 1 prong. It doesn't say if you have an investment of money, you're a security. It says nope. It says if there's an investment of money, continue now to the other prongs of the Howey test, right? And securities law and Howey test is very clear that you must have all 4 of those features, even under Howey, and in order for securities laws to kind of kick in. So that was a lot more than I thought I was going to say. So I'll just be quiet and let everybody respond.
All right, so thank you, Chris. Here's what we're going to do. So Teresa, but then I think Coy, you may have tried to get my attention. Collins, I'm not sure if you were still trying to get if you wanted it.
Yeah.
All right, so Teresa, 1 minute, if that's okay. Coy, 1 minute, if that's okay. Collins, 1 minute, if that's okay. through the conversation, we're hitting on a lot of the topics that have been offered up, and then we'll take it from there. So Teresa, Coy, Collins, and then pivot.
Okay. Feel free to interrupt me, okay? So, with all due respect to my friend John Stark, who I also was at the commission in very difficult times like post-Madoff, and none of us are in favor of victims, and I think everybody here is against victimizing people in any kind of way. And I do have to push back a little bit about no ransomware without Bitcoin or crypto, because I do believe that indeed there would be a lot of ransomware continuing, just like there was ransomware before Bitcoin, that it will continue with or without Bitcoin, and that people do bad things with lots of things. So people do bad things with crypto, they do bad things with fiat, they do bad things with paper, all sorts of things. But just because they do bad things, it doesn't mean that you outlaw it, or it doesn't mean that you ask the SEC to step outside of its statutory authority and become the overbearing mama government to take care of everybody and protect them from everything, because that's not, they don't have the statutory authority to do that, and doing that would actually be breaking the law. So I'm really cautious about asking the SEC to step in and do these things when they do not have jurisdiction. And I also caution the fact that, look at all these people, we're all pretty smart, right? And there's lots of smart people who've been talking about this for years, trying to figure out how are we defining these things? Because just because there's a problem and planes are crashing doesn't mean I want the SEC to now try and take over for the air controllers, you know? And so I think the fact that we've been dealing with this for such a long time, it shows how complicated it is, and it shows that we really need to dig in so that the SEC isn't acting outside of its statutory authority. And I really applaud what they're doing and coming out with things that are like so clear, like memes, right? Things like that, where it's like, this is not a security. And there's only so much they can do, because, you know, there's an executive order out there that says digital asset industry plays a crucial role in innovation and economic development in the United States and our international leadership. Like, is the political question doctrine now being invoked? I don't know. Does this change the major questions doctrine application in courts? Maybe. You know, it's like, there's so many bigger things here that I think we need to think about, and not call on the SEC to be the, you know, overarching to fill in any kind of hole somebody might see with fraud. And there's other regulatory agencies that might be better suited for some of these things. And I mean, fraud is still fraud. You can't lie, steal, or cheat. That's it. With or without securities laws. Can't do it, it's illegal. Somebody can come and get you for it.
Coy.
I'm largely in agreement with Teresa, maybe just to put a couple finer points on it. I really would urge the SEC to stay focused on its mission. Some of the issues have been raised on systemic risk. The SEC is not tasked with looking at systemic risks. FSOC exists for that purpose. If FSOC wants to look at it, they're certainly welcome to. For what it's worth, FSOC has looked at crypto assets since probably at least 2018 and hasn't really seen a big problem with it to date. With respect to anti-money laundering, sanctions concerns are very valid and real. The SEC has a very narrow jurisdiction in that space for registered entities, and they work together with FinCEN, and they work together with OFAC. So I think obviously focusing on that, if those registered entities are allowed to engage with crypto assets, certainly makes sense. But otherwise, I would just urge the SEC to stay focused on the concerns with crypto within their jurisdiction.
Collins.
Yeah, just really quick. I think on John's point, I think I might actually break with a lot of the people that I think consider me on the pro-crypto side, and that I actually agree that a lot of the negativities and the fallout are some of the most pernicious things that our component of the industry kind of produces. But even with that said, I think a lot of the times crypto critics get into this mode where they're making actually genuinely great points, and then they hyperbolize to the point of like disbelief. And like one of the things is like the first set of ransomware occurred in 1989. If any of you all were on LimeWire back in like 2005, you had your computer locked with ransomware. All of those things did exist. So I think it's definitely a valid point. And I actually will not go to the point of saying, oh, well, other people do it and it's just as bad. I actually do think we have a unique problem within the industry, but I do think that it severely undermines a lot of our crypto critics' points when they jump to this weird hyperbole for things that it's not necessary. And this gets to the second point, which was on Lee's point, the meme coin guidance wasn't based on caveat emptor as the logic. It was, yes, a warning to people, you should be aware that these things are not under the protection of the laws, but the premise was based on a Howey analysis. It was that you didn't have this investment of money in a common enterprise in any of these meme coins. To the extent that you do, or you use meme coins for those investment transactions, you're still subject to the act. So again, I think you guys both raised phenomenal points on those, but it's weird to mischaracterize what's occurring when your points are already really, really valid, and I think it's a bit strange.
But, ask any cybersecurity attorney, but for Bitcoin, there would be, ransomware. Ransomware back then was maybe $25 gift card. Now it's $15, $20 million payments, and it wouldn't happen without Bitcoin. The FBI will tell you that, DOJ will tell you that, and you can come to my conference on April 22nd where we talk about all the different types of cybersecurity and have a ransomware panel, and every single person on that panel will say, but for Bitcoin, there would be no ransomware.
Do you know
That's
how
not
much the
hyperbole.
first ransomware amount was for the AIDS Trojan?
Pardon me?
Do you know how much was in that first ransomware attack in 1989?
No.
There were 90,000 floppy disks given out, and it was something like $25 to $50 each. It was already a couple $100,000, first attack. So I'm not sure where you got that from. Now, I agree, like 10, 15 mil more, absolutely, much higher. And that's why
It's
I say
all
I actually.
Bitcoin.
But
Every
from
ransomware attack right now is
1990
Bitcoin.
From 1990 to 2005, more than $30 million of ransomware attacks happened. Now it's been substantially higher, and that's why I say it's absolutely right that we should be focused on that, in crypto in particular. But it's weird to say, oh, like Bitcoin invented this, and if Bitcoin stopped existing.
So I'm sorry, just going to jump.
He didn't say Bitcoin invented it, and I totally agree with you. It obviously predates Bitcoin. But, a few years ago, FinCEN issued a report tracking ransomware-related SARS filings, okay? And so if you look at that report, every single, and obviously that's a subset of every ransomware payment. So, but at least every single SAR filing tied to ransomware, the ransom was paid in crypto, mostly Bitcoin. Your second one, Collins, on the meme coin guidance, I actually do agree with you, by the way. So obviously if you read the guidance, it's grounded in Howey, which, and frankly, I agree. Like most meme coins are not securities. I didn't think it was actually necessary to say that in staff guidance. My understanding is that the reason that was put out was to serve as a warning, and I believe Commissioner Purcell, correct me if I'm wrong, had a accompanying statement sort of along those lines, saying like we are here to tell you that if you lose your shirt in a meme coin, don't come crying to the SEC, right? So that's so I agree with you that it's certainly grounded in Howey, but the intent was to warn the public.
I just wanted to maybe just see you, Collins, and raise you one, because I also agree with John that it is a problem. I agree with you. I think the problem is not, the question is not, is it a problem? It is. The question is, what is the solution? And I think sometimes those who, they say forget history are condemned to repeat it. What are we going to do about this? And it sounds like from all your writings that your goal is let's just try and eliminate any crypto anywhere we can find it. I recommend a book to you called Last Call, The Rise and Fall of Prohibition. It's a great book because there were many, many problems prior to Prohibition. It was a pernicious problem. It was a legitimate pernicious problem. And the attempt by the government to tell people don't do something you want to do failed miserably. So I don't disagree with you, John. It is a problem, but just telling people and wagging your finger don't do it ain't going to be the effective means.
All right, so let's take that as the opportunity to think about a bit of a pivot here. But one of the things that was interesting from my perspective of the conversation is, at least as I've been deciphering, is there are just different views and perspectives as to how to approach the what is it question. And I think we've seen that for the last 20 minutes, and I'm not sure we're going to solve that today. I certainly don't have the solution to that. Tall order for the commission, but I think it's illuminating just through the conversation and the back and forth to see that some of this isn't just about nuances around how does one interpret or apply this prong of Howey or that phrase within the broad definition of security under the 33 Act or the 34 Act. They are just very different views as to what's the right frame, what's the right question, what's the right lens to put on the is it a security or not. And I think it comes back to the work that the definition does in terms of figuring out, does the SEC have jurisdiction? Or, picking up on a point that Teresa alluded to, if not the SEC, who? Because somebody else is going to have jurisdiction. And then that may relocate some of the discussion to say, well, but do we think they have the appropriate authorities? interesting whether or not that discussion is one that ought to inform the threshold question as to whether or not the SEC has jurisdiction, or if rather that's a discussion as to that agency and those authorities and that legislation and that regulatory regime. So it's been interesting for me to see all of those points come forth, because I think that the best way to figure out what the path forward is, which is the pivot I'm going to make, is to have all of that surfaced. And so at least everybody understands the different perspectives that are being brought to bear. One, that's the best place to see where there is commonality, where there may not otherwise appear to be, or just see where there are genuine differences and the reason for those differences. And then ultimately, policymaking is about making choices and judgments about what the right way to proceed. And of course, advising clients is about making judgments as well about what it takes to be compliant. So with all of that, here's the pivot. And again, a lot of what the discussion has indirectly spoken at least to a number of the comments that and questions that have come in. But I wanted to pick up something, and I think, Collins, you were making reference to it a couple of comments ago, and some others were as well. I want to very much keep the discussion focused on the purpose of this roundtable, which is what's a security, or are crypto assets securities, and when and which ones, and not turn this into a discussion about substantive regulation. So with that cabining of us, I do think there's an important question. And again, Collins, it comes back to something you were saying, but I'll just open it up to the group. That's this. One of the, I think, and we've heard this today, I think, challenges with the lack of clarity for some. Some people think it's clear, others think it's not clear, but for the lack of clarity, as a lot of people see it, in terms of whether or not a particular crypto asset is a security, or whether or not a particular transaction involving said asset is a securities transaction. I think part of it, as a practical challenge, is all right, well, but if it is, then what do I do? And so just a very practical question of, all right, if this is a security, or this transaction involves a securities offering, what have you, secondary transaction, well, then what? And then the practical challenges when it comes to compliance with what the natural implications are under the federal securities laws if you have securities and you have securities transactions. Because if you do, you got to do a bunch of stuff. And the question is how do you do all that stuff in a compliant way, going to Sarah's point, given the nature of the underlying technology? So with that as a backdrop, and just mindful of the different views on the is it a security or are they securities and when question, to what extent indirectly can some of the difficulties and challenges and line drawing and measurements and what have you that go to the definitional question indirectly be resolved through the substantive regulation or pathways that actually speak to say, well, at the edges, we may not know for sure if it is or it isn't a security, but at least what you have to do, we're going to tell you what you have to do under these circumstances. Does that alleviate any pressure? And again, I don't want to turn it into that substantive discussion. What might that look like? But does that alleviate any pressure on trying to get it exactly right, given all the different competing perspectives on what's a security in the first place? I don't know, Colin, since you kind of inspired the question, I'll start with you.
Yeah, and I'll be quick. I think it will. I think it won't resolve all of the issues, but to the extent that there is something like, let's say, an exemptive framework that says, okay, when you have a securities transaction, you operate in X, Y, and Z manner, these are the disclosures that's required. I think that would solve a significant amount for folks that are saying, all right, well, I can just opt in. And the reason why I know this is because when 2017 or 18 happened and SAFs came out and then fell out of favor, a lot of folks in the U.S., SAFs are still being used outside of the States, but you actually found a lot of people started inherently structuring their offerings as Reg D offerings just prophylactically. Obviously, then subsequently, I don't think it's the current case, so we can mention it, the Telegram order came out, and that actually undermined a lot of people structuring that way because they thought, well, I can do a compliant Reg D offering, and then at some point when the thing is not a security, I can move forward. That obviously was taken away, and I think to a certain extent that was arguably understandable in that context. But to your question, one model is the exemptive framework then reduces some pressures from folks that say, look, I can operate in this non-security or securities law context, I'll just be compliant. And we already have people trying that now. The other thing is on a registered pathway, if you could, even if it was just as simple as saying, hey, here are the things from Reg SK to here that we want to see, absolutely. Then all of a sudden you have people saying, all right, well, great, I can go and register because now it's not that I have to produce audited financials or something, it's that I've got to have my open source code available and something else. So I don't want to, like you said, I don't want to get into the details. I think the primary focus is if you provide pathways, there are already people that are trying to do this, and they're saying it's not about not identifying people. Like I already have people at KYC, I know all of these people, I have the relationship. The only issue is I can't figure out what I'm supposed to do with, let's say, an audited financials requirement where, what am I going to report, the protocols revenue? Do I do something else? These are the practical things that without guidance, no one could register even if they wanted to, and folks have wanted to.
Teresa.
Yes, I think there are some things that you could do, and particularly the 33 and the 34 Act, the 40s Acts too, but I'll focus on 33 and 34 have very broad exemptive authority with regard to securities, security, transactions, people, classes thereof, and not only to exempt them, but also from any part of those acts, as well as conditionally or non-conditionally. So there are a couple approaches. So if this question is so, we can't really get to what the security is, you could frame an exemption as something with these characteristics, are not a security, or these, and you could basically narrow the definition of a security through the exemptions. And that is a bigger kind of use of the exemptions than we've seen, but that is something that Congress specifically and purposefully gave. And I believe that it also you can exempt people from every part of the securities code so that it doesn't have any impact of the securities law. So that means 10b-5, that means Section 17, not just registration, but everything. The private right of action is really, it's judicially created. And so if you look at it from that way, you have to justify it as being consistent with investor protection. But consistent with investor protection, I think we've seen the negative impacts from having something all of a sudden a security. The real losers there, the people who lost the most money, were the people who own the asset. I don't know that was really consistent with investor protection. And so I think you could do that if you come up with something that you think should fall outside the securities laws. It doesn't mean fraud's okay, because we still have the fraud. It just means we don't need to modify our fraud laws so that the efficient market hypothesis is baked into the fraud requirements such that there's no reliance, and fraud is like the fraud on the market. It's assumed that the fraud is within the price of the asset, and so it's basically modifying a little bit of that liability issue. But fraud is still fraud, and fraud is still illegal and can be brought out, or people can be prosecuted for that. And then separately, you could also come up with some sort of exemption for things that are securities, but you want them treated a different way. And that's when you utilize the conditional part of it, right? And so then you can have the exemptions and then condition, certain types of disclosures, like more like a licensing kind of thing if you want, or Reg CF is a great example of something like simple, basic, somebody can do it for maybe like $5,000 or, and that kind of a disclosure, and you can file something, and as long as you are able to, as long as you actually have asymmetry of information, and there is somebody who can disclose it. And then just like Reg A, you have, Form Z. So here you could just say, well, I don't have enough of my, I can't make any more disclosures, I don't have information, here's my form, to depart. So I think that there's a lot of different tools and a lot of different things that we could use the exemptive authority through. And fantastic economists here to go through the cost-benefit analysis, I think. And so I do see that could be a pathway.
Yeah, so let me pivot to another topic, just keeping track of time. We got 15-ish minutes left, ending a little bit before at the top of the hour. So maybe one or two people per each of the next. I know there's so much more that folks want to have a chance to share, but we don't have time for everybody on every point at this point. So try to keep it to one or two folks responding. Coming back to some of the questions that we've gotten, I don't think the topic of fungibility, NFTs, has at least expressly come up today. I'm curious if anybody wants to share a thought in terms of how to think about what people refer to as NFTs and the ways in which fungibility does or doesn't map onto, Howie or other aspects of the definition of security. Any takers on NFTs, fungibility? Looks like Lee has a thought.
John's volunteering me.
Looks like John is volunteering.
Yeah, so I'll just note that I do have a section on NFTs in my statement. I mean, not that I'm a NFT connoisseur by any means, but look, I mean, I think it's probably true that most, at least the ones I've looked at, are probably not securities, not investment contracts per Howie. But again, it's facts and circumstances dependent, right? And it's clear that some are, and obviously I know Commissioner has been dissented on several NFT-related enforcement cases. But back to my point at the way back when, there's also private litigation, and there was a case. Hopefully, I'm allowed to talk about cases not SEC enforcement related, but Harper versus O'Neill in the Southern District of Florida, federal court, Federal Judge Moreno. Looked at the facts and circumstances around a given NFT and said that they did meet the definition of an investment contract. So again, I don't have like a blanket, statement to make, and I guess that would be my recommendation to the commission is unlike the meme coin guidance, I would highly discourage you from considering putting out some type of broad guidance around NFTs, because again, it's always going to be facts and circumstances dependent.
Miles.
Yeah, I mean, I generally agree with you. I think that it should be a facts and circumstances analysis. I would say that one thing I would highlight is that I think that the Commission's actions against some NFT companies is actually evidence of how politicized, the agency's approach has been to the industry. There are tons of examples of video game companies that sell assets within those games prior to those games being launched, and they fund the development of those games with the sale of those games. Now, just because those digital assets are not cryptographically secured on a blockchain, they're somehow not securities transactions, but NFTs sold on a blockchain are security transactions. So I think it's very important that the agency kind of steps back and looks at the economic equivalent transactions that are taking place in ordinary commerce that have not been treated like securities transactions, and reevaluates its criteria for assessing the securities law's application to NFTs.
One of the other topics that we got a few questions on, we talked about it a little bit earlier in the day, is on secondary trading, as compared to, I'll call it primary issuance, although I guess to use the word issuance is to, in some sense, conclude the answer to the question that's being discussed today. But I'll use it in the general sense. I'm not going to use it in the is it an issue under the federal securities laws sense for purposes of the question. But I know there's a lot of thoughts, and I know that there has been a lot said over, well, even if something is a security upon quote-unquote primary issuance, if you allow the use of the word generally here, that when it comes to secondary trading, perhaps not. I think that actually dovetails back, Louis, to the point that you've written a lot about, which is say, well, wait a minute, to say secondary trading versus, say a primary issuance begs the question of what? What is the primary issuance of versus what is the secondary trading of? And is it a primary issuance that is, say, an investment contract where the token is something different, disaggregated from the investment contract as such that when you have secondary trading, if it's secondary trading of the token, but the token wasn't even the security when it came to the primary issuance, then how could the secondary trading actually be a securities transaction because it wasn't a security at the primary issuance? That requires the sharp distinction between the investment contract on the one hand and the token or crypto asset on the other. But it is something that I think folks sometimes wonder, well, wait a minute, how can I wrap my mind around it was and then it isn't, but maybe it is, but maybe it will be in the future? That's the broader point in terms of things can change. But specifically on secondary transactions. Louis, I'll direct this one to you. What are your thoughts?
So I'll certainly be brief, Lord knows. But you're right, Troy. I think, there's been a little bit of heat here on this topic, and I'd suggest maybe turning down the heat because there's some really just practical questions. What difference does it make? Let's ask ourselves that. What difference does it make? I think there's broad agreement, as you alluded to, Troy, that regardless of what the asset is, if there's a fundraising transaction that meets the four prongs of Howey, it falls within the securities context and either should be registered or exempt. And then you have something that probably by itself does not meet the four prongs of Howey, and it's being exchanged. So if it were to be treated as security, as has been suggested we should, how would that be different in a secondary market? And so the first question is it need to be traded on a national securities exchange or an exempt alternative trading system? That would be one implication. If it was a security, it would be. If it was not, it would not be. And so we just need to ask ourselves, if we are going to treat perhaps quite a lot of tokens that would appear to be subject to some level of control, then they would need to be traded on national securities exchanges or alternative trading systems, or not traded at all in the U.S. So we'd have to cross, that bridge. And then the next question would be, what about all the other rules that apply to secondary trading, in particular things like the Williams Act and otherwise, in terms of aggregation of information and control? Those things don't currently apply to crypto assets that are not securities. I would say that, a thoughtful regime that tried to figure out how to kind of apply those in a way that made sense for crypto would make sense. You'd also, if in secondary transactions the tokens were widely held, you'd at least ask the question, should there be general disclosures that are on an ongoing basis? One of the reasons our equity markets in particular work so well in the United States is because we have very, very clear and firm rules about periodic disclosures, including current disclosures, that allow the markets to address information. And I would say, Troy, that I would also strongly endorse such a system to be adopted. That, unfortunately, is likely mostly the realm of Congress, but we would see that. So I think secondary markets, it doesn't need to be this sort of high-level OMG kind of situation. I think there are practical questions, and they have practical answers. So, yeah.
One of the points that was made earlier is, Teresa made a reference to the point that if you look at the definition of security, turns out there's more than just investment contracts. And I know the Commission is very well aware that there's more to it than just Howey and just investment contracts. Of all the different phrases, words, types of securities that are within the definition of security, whether you're talking 33 Act or 34 Act, which is particularly what we're, I think, contemplating, even though it turns out there's more than the 33 and the 34 Act of the Federal Securities Laws. I think kind of what's in folks' minds is primarily the 33 and 34 Act, at least today. The other type of security that gets the most attention, though it is a distant second to Howey and investment contracts, are notes and reeves. And so I'm curious if anybody wants to speak to kind of the practicality, as a practical matter, right? Just set aside legal questions and what have you, and the Reeves test is interesting because the fourth factor of Reeves is essentially, does anything else reduce the risks that otherwise the holders of the notes would incur? So it's an interesting fourth factor in terms of just a jurisprudential construct, very policy-oriented, going in part to the kinds of things that Lee and John were talking about. That's expressly in the jurisprudence of Reeves for purposes of notes. It's not there expressly in the jurisprudence of Howey, insofar as Howey is articulated by the courts. But with all of that, as a practical matter, is there much consequence of whatever uncertainty, lack of clarity around whether or not a particular crypto asset is a note, or is that more of academic interest, but in practice isn't something that has much consequence?
Yeah, I think the note analysis comes up most often in a staking context. And so the different, I think it's the different types of transactions are oftentimes, where these come up. And the way that I think about this is thinking about, like, what are you actually getting and when is that transaction over? And it's been very clear for the most part until now that when you get something, it's done, right? Now, what you get might be something else, or so like with the note, for example, it could, there's the note transaction, and then when you're getting paid your interest is, are you getting paid, and is that a security, right? Like normally, no, that's it. But then to continue to treat what you get back, treat your interest as a security, then that's a separate analysis. Just like in Howie, when the use of proceeds, when you get the token, usually like in a SAFT, it's clear. I give you my money, and not to go back to Howie, but just to kind of explain how I'm approaching it with all of these things is, that's the capital raise. I'm trusting money to somebody in both ways, in both notes and investment contracts, and they're developing something. I'm promised like their efforts, and I'm promised the proceeds from their efforts, and the proceeds of their efforts is a token. That's it. Thank you. I got it. To me, transaction over. But is that, whether in a note context, profit type of sharing, or investment contract, or all these different things that it could be, then the question becomes, is that thing that I got, is that now a different type of securities transaction? And I think that's kind of where some of the analysis is getting conflated.
John.
Yeah, I agree with that. I think that it's always going to be this facts and circumstance test. If you look back at prime banknotes, remember those? Our office did a lot of those enforcement actions. These were bogus instruments that purported to represent a secondary market for standby letters of credit. Huge mouthful. Some of them just paid 1% above prime. Some of them were much bigger. It came over from Europe. They dominated, especially on the internet. The fraud was everywhere. And when we sued them, when the SEC sued them in a case called SEC versus Lauer, they asserted the SEC doesn't have jurisdiction because these instruments are entirely fictional. So how can the SEC have jurisdiction, right? So I think, I can't remember which circuit court it was, but the court came back and said, look, if it were true what they purported to be, then this would be a security. So the SEC had jurisdiction over prime banknotes and was able, by bringing all these cases, to essentially eliminate that fraud certainly from the United States and maybe even further at the time. So I look at it sort of like Teresa does, as sort of facts and circumstances.
Corey.
When I think of the notes and Reeves' analysis, I think this is maybe a good example of where the task force could look in terms of staking, of providing clear guidance when a lot of staking services I don't think really meets the Reeves test. And I think if there's a way to get comfortable for the task force there, that'd be great. But I also think of it in the lending context, right? I think that's where the SEC has successfully brought some charges. And I just flag in the context of there's not many centralized entities doing crypto lending out there. But one of the many travesties of the last 4 years of the SEC was the settlement against BlockFi that told them
No names.
Settlement against one issuer of a lending program that said, come in and, you can come in and register, but by the way, there's an Investment Company Act problem and you have 6 weeks to figure that out. And then 6 weeks came by and it never got figured out. Like, if there has to be a way to move forward if you're going to tell people to come in and register. So I just wanted to plug that.
And then, is that Collins or Ben?
Yeah, just on Teresa's point, I know she mentioned staking, and I think Coy just kind of alluded to it, but separate from like centralized crypto lending, it definitely would have a very significant impact on clarity for DeFi. There are several structures that we deal with that actually don't look like investment contracts. They actually look like they may, if they were to be analyzed, be more under the note context, and that again has substantial implications for one, the default being most treatment of notes treat them as debt securities. That comes with a whole host of implications that aren't applicable to equity securities. So that distinction alone ends up informing a lot of the downstream regulatory impacts. And then just a question for you, I don't know if maybe this is the right time or hopefully somebody else has brought this up, but other categories like profit sharing arrangements or participation in a profit sharing arrangement is actually something that I'm actually kind of curious to ask the SEC folks about, because it's been one of those things that I actually think tends to pose more of a challenge if the SEC were ever to raise this, because some folks say we just look at that under the Howey analysis, but in canvassing case law, it's actually there's very, very little case law about what constitutes participation in a profit-sharing arrangement. And being frank, a lot of the stuff that we've talked about, a lot of the stuff we deal with in DeFi, that probably seems more of a relevant thing to get clarity on. Now, if the answer is we're just going to use Howey, great, like it's easy. But it's actually never really been clarified. And I'm wondering if you have a question on that, or maybe somebody here could tell us that. It would be
I'm not.
fantastic.
I never did speak on behalf of the commission, and I'm still not speaking on behalf of the commission. Let me just make one quick comment on that, and then I'm going to come to Chris, and then we may be at time. But I think the point is, and it underscores a point that others have made, is an important one in the broad sense of the definition. Right, so much focus has been on Howey, and understandably, and again, sometimes there's focus on Reeves, and then a lot of the other types of securities just don't get as much attention. And I do think that who knows how things play out, but there could be some potential at some point in the future when someone says, hey, well, wait a minute, okay, well, Howey is that and Reeves is that, but turns out it's a pretty long definition. So where does all the other stuff situate itself? So in that kind of broad point around clarity, as well as workable substantive rules, regulations that advance across the breadth of the SEC's mission, to your point, there's a lot more in the definition of security than Howey and investment contracts, Reeves, notes, and it's a good reminder, I think. Chris.
So I'm going to sabotage that a little bit, but I will gesture towards notes and Reeves, and I think that there's a general consensus that Reeves is even less predictable than Howey is in terms of a sort of, in order to sort of set expectations as to whether or not securities law is applicable. But Teresa's statement actually reminded me of just one little, because I know we were asked to be auto mechanics, so just one little interesting question, because the capital formation process was brought up, which is when exactly, even under Howey, does the capital formation process end, particularly in the initial raise? Because often you have, equity warrants in a grant, you have token minting, listing agreement with an exchange. Well, whether or not capital formation ends or continues post-minting, and whether or not the initial token sale is ultimately facilitated by the listing, right? Some kind of guidance as to whether or not listing is the final step in monetizing tokens, because if it is in that direction, then it could be treated as part of the offering, and you could have really interesting things popping up, like listing agreements comprising part of the offering and the like. So that's an interesting and probably very practical task to clarify. Thanks.
Miles.
Yeah, so I would just say that I think going back to the kind of the control discussion that I've raised and several of the people have talked about, I think that is the overarching premise that would allow you to create a uniform and unifying principle across these regulatory regimes, right? Reeves is implicated, as Collins was just saying, if I deposit a token into a smart contract and then someone takes that and it issues me a stable coin back, and someone goes out and takes that token and tries to make money on it and then delivers those proceeds to me, that looks a lot like Reeves. If there's no one behind the smart contract and it's not controlled by anyone, then it's just fully autonomous, and the trust dependencies that get at the point of Reeves are no longer there. The same thing applies to profits interest. How can you have a profits interest in a smart contract, a piece of autonomous software that's not controlled by anyone, as compared to what the purpose of that regulatory regime is looking at profits interest in business entities. So as a result of that, right, I think control is the unifying principle that basically can be used to go across all of these different regulatory approaches. And I think that that's very important, right, because we need to have consistency in how we're thinking about the problems and where the risks arise.
Great. Thanks, Miles. So I think we're at time. I know there's going to be a few closing remarks. I thought the discussion was amazing among the panelists. I think encouraging that there's so many folks who are thinking so much about this question. I think it speaks to the stakes. I think it speaks to their own commitment to try to think all this through. I think it's safe to say there's no single way to approach this. I think that makes certainly interesting, makes it challenging for the commission, but I think that the commission is going to be much better able to land where it's looking to land with the benefit of input like this. Whether folks end up agreeing or disagreeing with how things play out, that's the natural part of the process, but the engagement I think is certainly encouraging, and hopefully that the task force found the conversation to be useful. So with that.
This is so fun, isn't it? What a cool day. So we're almost at 5 o'clock on a Friday evening. So where else in the world would you want to be than here? You guys might want to think about the life choices that got you here. So 6 months ago, I could not have fathomed a day like today would have happened, and I'm so excited to be here, to be working on these issues with the folks at the SEC and the folks from the public that have given it so much thought. Many have long asked for a regulatory framework for crypto, one that's workable, and now we have the opportunity to be part of constructing that. This is really exciting, but it's also a tremendous responsibility. Every single member of the crypto task force understands the gravity of this responsibility. And so this effort today, trying to engage with the public in a meaningful way to have substantively meaningful conversations is a part of that effort. We hope you continue to follow along. We are going to have 4 more roundtables that are focused on key issues in this area. We have also stood up a website that seeks input from you guys. You may have seen the written input page. I've heard that some people are stalking it, and it's really exciting, and WhatsApp messages are flowing because of it. So please continue to look at that page. There's a lot of really amazing scholarship on there, a lot of really great ideas. We're looking at them very closely, but we also hope that you'll contribute to it. If you've been thinking about these issues, we really welcome your thoughts on that. We also urge you to look again at Commissioner Peirce's February 21 statement, in which we outlined key questions that we're considering. That is also part of our process in getting the right input to make a strong framework for us. So that's it for us. I want you to enjoy the rest of your day and enjoy your weekend. And thank you to everyone on this panel and everyone in this building that helped make this possible.